everybody. It's Jessica Stone at Stansberry Research, and I'm joined now by Brian Tycangco of True Wealth Opportunities China. And Brian, this week, the Star 50 Index begins. What is the Star 50 Index in China, and why is this important?
Okay, well, the Star 50 Index is basically the equivalent of the NASDAQ index for China's star market, which was launched last year. So it's their kind of like little NASDAQ, which actually has grown quite a bit since then, from just 25 listings now to almost 120 listings, including the biggest IPO in the last 10 years in all of China. That's for SMIC, or Semiconductor Manufacturing International Corporation.
Right, and we have done some reporting on that already, but that has done really well. Last week, we saw some really big numbers there, right?
Very big numbers. I mean, on opening day, the IPO, the stock tripled on opening day, which is kind of like the average gain for star market IPOs of late. But for a company as the size of SMIC, now close to $70 billion or roughly $80 billion in market cap, that was a big move.
All right. And last week, we also got a report of GDP growth for China. The second quarter came in at about 3.2%. That indicates that this economy, the world's second largest, appears to have been the first to actually show growth post-pandemic, something that the EU and the US could only dream of having, right? But if I can move from GDP growth to stock market growth, we also see this increasing tension between Chinese authorities and the Chinese stock market. What's going on there?
Okay, so GDP growth, yes, that was a great sign, but the market sold off. So you're kind of, a lot of people are scratching their heads wondering why the stock market sold off. The reason is basically it's sell on news kind of environment. People were anticipating that China's GDP was going to grow, but it did grow much faster than expected. I think they were expecting 2.8%. It grew 3.2%. Now, the worry here is that, the Chinese Communist Party is really, sort of worried about a repeat of 2015, where we had this spectacular boom and bust the Chinese stock market. And the Chinese stock market is known for having spectacular booms and busts. This
much
time
more
they
volatile
wanted,
than our exchanges in the West, right?
yes, that's because 80 to 90% of the Chinese stock market is really dominated by retail investors. I mean, I'm talking about people buying through their own accounts and buying based on their own decisions. And the mutual fund industry and the ETF industry in China is still very small. Just a fraction of Chinese savings is invested in stock-related ETFs. And this is what China wants to do. It wants to transition the market from a retail-driven market to a more institutional-driven market, which will give it more stability.
Yeah.
But until that happens, you're going to see this the Chinese government step in every time it feels that the market's getting ahead of itself. And I think that's good for investors right now. I mean, you will see these, big rallies, then a sell-off afterwards, creating big opportunities for the investors who really know what's going on.
So in that case, right, we know that Chinese economic reforms are making it more attractive and more possible for mutual funds and institutional investors to get into the Chinese stock markets. Is it better in that kind of market for an American investor to be in a fund or in retail investing themselves?
Obviously, they're better off investing in a fund. I mean, it's going to be difficult to ride, the volatility that's driven by the Chinese retail market. And when it comes to foreigners investing in China, creating funds actually goes in line with, the long-term goals of the Chinese government, which is the development, the slow, steady development of the capital markets, of the financial markets. And they've set out this goal. And, whenever they set out such goals, they usually achieve it by hook or by crook. And as an investor, institutional investor, you are basically riding that long-term trend. But then you should be able to ride the volatility in the near term. and know when to pick your entry levels in terms of investing in China. So when there's a big correction, as we're seeing right now, I think it's a big opportunity for a lot of investors to start nibbling at Chinese stocks.
All right. Ever the China bull, as I like to call you, but also some really good nuance there, Brian. Thanks so much for your
You're
thoughts
welcome.
on the latest going on in Chinese investing. And if you would like to see much more content like this, please do subscribe to our YouTube channel. You can also find us on Facebook, Instagram, Twitter, and LinkedIn. That's all for now. Thanks for watching.